And he's also sold a lot of companies, so Twitter, Google, and Apple. So he heads up our group, great guy, and he'll be moderating. Enjoy the discussion. Thanks.
Jack.
Thanks, Jeff. Hi, I'm John Bautista. Thanks, Chad, for helping to organize the Total Access event. Thanks for everyone for attending this morning. We've got a great panel, and I believe a very interesting discussion around what's going on in the market on the side of liquidity, both on the IPO side and the M&A side. I don't know if anyone saw yesterday's Wall Street Journal business section talking about, well, is there a bubble again in Silicon Valley? It seems like every couple of years that question gets raised, and I think we'll provide some insights into that today. Some interesting transactions recently. Of course, got a lot of press, the Nest sale to Google. We were fortunate here at Orrick to represent Nest in that transaction. Took away a lot of time over the holidays, but it was great to see the deal get done and establish hopefully an interesting benchmark for acquisitions. It's the second largest acquisition that Google has done at $3.5 billion. And of course, we continue to see the continued uptick in Twitter stock, despite the fact that I think only 3 analysts recommend you buy the stock. It continues to go up. So maybe John can tell us what's going on there. IPO lockup hasn't expired yet, or maybe something like that. And a lot of activity on the M&A side, private companies being sold to the serial buyers. As Chad mentioned, we had a lot of M&A activity in sort of middle market type acquisitions with Google and Twitter and Apple buying a lot of the companies that we represent, and as well a lot of activity even at the lower end in terms of the acqui-hire kind of transaction. So I hope we can provide some insights there. So we'll spend about 30 to 40 minutes hearing the perspectives of the panelists and going through some data both on IPO and M&A, and then open up the discussion to your questions. I'd like to introduce today's panelists, and I'll go from left to right. So to my left is Brian Curran. Brian's VP Capital Markets and head of co-sales of the NYSE. So it's terrific to have a representative from the major stock market here, and NYSE has done a great job in terms of listing of new technology companies in the Valley. Brian has extensive background working with venture-backed companies, in addition to sell-side M&A experience, and he's responsible for developing the corporate listings and relationships with issuers in the Valley, manages a 30-plus sales team here and is located in Palo Alto. To his left is John Moriarty from RW Baird. John and I have done a number of these panels over the years on liquidity and other topics. John joined Baird in 2007. He's managing director of their investment banking office here in Palo Alto. Prior to that, he was 13 years at A.G. Edwards, which is now Wachovia Securities, and helped establish their West Coast technology investment banking practice. Mark Farley, partner, Deloitte, just got done with an IPO, I think of Ruckus Wireless. He was mentioning to us earlier. Mark has 25 years experience in public accounting, focusing on technology, and the hardware sector is a particular area of focus for Mark, and as I mentioned, he's done a lot of IPOs recently, and we'll get a good insight from him as to what is to come in 2014. To Mark's left is Damon Cronkey. Damon's VP Biz Dev and Corporate Development at SurveyMonkey, and he joined in 2011. Prior to that, he was Senior Director at Yahoo, in charge of M&A and across multiple business units, and he ran a lot of deals, and I think we probably were opposite each other on a number of deals that we were involved in on the sell side to Yahoo. And then last but not least, Peter Bardwick. Peter's CFO of Rocket Fuel, and he told us that right after this he's doing a secondary offering, so he's hoping to raise a couple $100 million by 10 o'clock. So we'll help. Can we help you with that?
Yeah, money.
So Rocket Fuel, terrific IPO, one of the successful IPOs of 2013. The company's doing terrific. He began his career working with Solomon Brothers and Citicorp Investment Bank in New York. Transitioned to corporate management. Became VP Finance for Westwood One, and which was the world's largest radio network company. He's held a number of CEO, COO, CFO positions for both public and private companies, and as I mentioned, recently CFO at Rocket Fuel. So welcome to all of you. I think we'll get started. We have a couple slides we'll walk through. Won't spend too much time on the slides, but I think it's helpful to get to see the data, and then we'll analyze that and ask some questions. So I think the first set of slides dealt with what's going on in the IPO market, and I think that was, and we'll go ahead and I'll let you do the slide presentation, but Brian will give us some insights from the NYSE perspective on IPO. So we've got some slides here.
Well, thanks everybody for joining. Hopefully everybody's awake, you've had some coffee. But I thought I'd share one statistic with you that I found last night while preparing for the presentation today, and that is that you can see a reasonable number of transactions here, actually the best in a number of years, since 2007 actually, in terms of proceeds. But if you kind of go back a little bit to 1999, there were 350 plus tech IPOs. But they had revenues, 80% of them had revenues less than 50 million. So there's a huge change in the companies that are going out today, much more seasoned. So I thought I'd just share that one statistic with you. So again, if you look at the data, you can see that it certainly has been a terrific year. Last couple of years actually, but 2013 was a banner year by all measurements really. If you look at the between exchanges here for a minute, maybe the only marketing slide here, so to speak, but you can see, with the exception of an anomaly for our U.S. competitor here in 2012, there's a significant difference in terms of total proceeds raised. Although on the number of transactions, we typically are close to each other, or in fact, 2013 exactly at parity in terms of number of transactions.
Mark works for the New York Stock Exchange.
So if you look at some of the pricing trends, I think what you'll see here, just in distilling this down, is that the average offer to one day for December was the second best showing really for the year. And interestingly enough, only one of the 12 deals in December ended down from its debut. So again, the quality of companies is certainly going up. The other thing to mention is that the pricing range, I think, is pretty consistent in the 40 to 50% pricing within the range in terms of the number of IPOs. So looking at the price performance actually, and what's interesting is that in December, 2 tech IPOs actually had outstanding returns, and that was Nimble Storage, or those were Nimble Storage and Auto Home, and both had over 115%. And that's actually, they joined 14 other IPOs last year that closed up over 100%. So in looking at the pipeline, the good thing about data is many people will slice it different ways. I've seen anywhere between kind of 50 to 60 as the number for the backlog. I should have mentioned all this data was as of the end of December, so we've already had a pretty active month already, so accounting for that, but call it somewhere between 50 to 60. I think what you do need to take into account, though, is with the Jobs Act, you don't have full transparency into that, so these are public filers at this point. So the Jobs Act dramatically changed the landscape over the last year and a half, 2 years. And I'm sure folks on the panel, including Peter, can talk about that, the benefits that they saw from that. If you look at, sorry, I was one slide behind. So if you look at the VC activity, to give the rest of the panelists enough time, I'm sure you'd like to hear from them more than some data from the exchange. But the venture-backed issuance was really significant. It was the fourth quarter of last year was actually the third consecutive quarter with over 20 VC-backed IPOs per quarter, and that's the best since 2004. Some other data points that are interesting, there were around 10 VC firms that generated $1 billion plus from IPOs or M&A in 2013. And of the 82 VC-backed companies last year, and this is from the NBCA Thompson data that was released recently, they raised $11.25 billion in proceeds. Some sources I've seen have shown this as 76, but the numbers are about the same, just slightly over 11 billion raised in the year. And then last few data points, technology companies accounted for about 13% of all IPO proceeds raised last year. That actually, from a proceeds perspective, though, is down over 50%. But you have to be careful because the anomaly is Facebook in 2012 in terms of the level that they raised. And clearly, biotech companies had a huge resurgence last year. Believe it or not, they actually accounted for more than 50% of all of the IPOs. There were 52 healthcare IPOs in 2013, which is actually an increase of 39 over 2012, and a staggering 908.7% increase in proceeds. So with that, I'll turn it on to
A quick question on the data. What's interesting is, given the number of private transactions that we hear about, companies such as Lending Club raising $250 million, Pinterest, $200+ million in private transactions, Uber having done a recent private transaction, Stripe, which Chad just mentioned, $100 million. You see a lot of private transactions where companies are raising as much capital, if not more, than they would raise in an IPO. So an interesting question is, do you expect the size of IPO transactions in terms of size of deal to increase, Brian or John, in 2014? Or how do you explain the fact that the average IPO size is actually relatively small to what's happening on the private side?
Yeah, so a couple of things. Number one, I think there are a lot of companies that candidly just don't want to go public until absolutely necessary, and so are extending out the time frame to go public. And these large private transactions often contain a large piece of secondary shares. So insiders are getting some liquidity that, if you went back 5 or 10 years ago, the private markets wouldn't have allowed for the kind of liquidity that they're allowing for today. There's a lot of cash on the sidelines. People are looking to deploy that, whether it's in the venture world, the private equity world. You're seeing the institutional investors like T. Rowe Price and Fidelity and others participating in these transactions as well. And so they're giving entrepreneurs and, candidly early investors liquidity, extending the runway, and allowing for IPOs to take place later in the life cycle of the company. I think we might see IPO sizes go up a little bit, but the IPO is only the day in the life of a company, and so people like to price the transaction, let it season a little bit, hopefully watch the stock go up, and then start putting more liquidity into the marketplace. Why sell more than 15 or 20% of your company in the IPO to begin with? And I think Rocket Fuel probably is a good example of a very successful IPO coming back to sell more shares within the lockup period.
Peter, do you agree with that in terms of the staging and do a relatively smaller IPO and then a secondary that might include shares from insiders?
Yeah, I think for technology companies, it's almost expected, right? Assuming the deal goes well, it's kind of two steps. You go public, hopefully the stock does well, and then you can sell more shares at a higher price, as well as certainly for us, reduce some of the overhang. There's been a lot of volatility in our stock in part because we have pretty low float. So the secondary will allow us to bring more shares to market, which helps our investors. They get some liquidity, and then helps the public investors by creating an opportunity for to buy a larger share of the company.
John, back to you. Would you like to walk through some of the M&A slides?
Keep going. If anybody would like more information from the NYSE.
Why don't we talk? Can you talk through your slides?
Sure.
He's got them. He's got them in his pocket.
Yeah, see?
Yeah.
That was a Boy Scout.
Plan B. This man is prepared for any eventuality.
Yeah, so, what I would say about the M&A market, and to give you some context, Baird, last year we completed 74 M&A trades, about $240 million average transaction size. And also we participated in 124 public equity offerings. But on the M&A front, a tremendous amount of liquidity in the marketplace. The liquidity is coming from both strategic buyers and sponsors. So, as we've moved through the recovery and we've seen strategics and, generally businesses feel better about themselves, strategic buyers are looking for ways to grow their business, and M&A is clearly an important way to do that. Additionally, the private equity community is extremely active and has a lot of cash that they need to deploy. And the only thing worse than not deploying it is giving it back to investors. So we're seeing a lot of private equity buyers extremely active, and the leverage markets for them is actually back to 2007 levels, if you can believe that. In some cases, the leverage markets are more aggressive, and private equity buyers can borrow more money than they could in 2007, which is almost hard to believe. But if you look at the activity on the top line of the M&A market, you'll see certainly the 2007 high watermark in terms of deal value and across the board. 2012 was very active in terms of deals, but from a value perspective, there were less billion-dollar deals that we saw more recently than as we had in the past in 2007. The middle market, which is deal values from $0 to $1 billion, is the market that is most active and really just chugs along year after year after year. And this is probably the most relevant market to most people in this room, and certainly the activity continues on and is healthy. Breaking out by sector, no surprise, technology is the highest number of deals on both sides. From a value perspective, it's number 3 on both 2012 and 2013. Again, probably not much of a surprise. If you look at the technology M&A marketplace in general, again, it's been very active. It continues to chug along. There is a wide variety of sizes of transactions in the technology world, probably more so in technology than anywhere else, just given the acqui-hires kind of smaller transactions up to the $1 billion plus larger transactions. No surprise from a multiples perspective, and this is really an EBITDA multiple. We're able to put all the sectors on an even playing field by looking at EBITDA multiples, which is a proxy for profitability. Not a surprise, technology continues to outpace the rest of the sectors, and has really fully recovered or almost fully recovered from pre-recession times. I think one of the more interesting sectors here is actually consumer and retail, where people are expecting consumer spending to come back, and as a result, they've been willing to pay higher and higher multiples for the high-growth consumer companies. One area that we like to watch very carefully is confidence overall, and it's kind of an eye chart. But as we think about the different things that drive and move the IPO market, the economic environment is certainly better than it's been in the last few years. Stock market, which allows companies to either raise cash or use stock as currency, is clearly better. The credit market I mentioned is back at or above where it was in 2007 when we were, at the height of the lending market back then. Investor confidence is better. The one thing that we would caution is the political landscape. I don't think that's a surprise either. Is probably worse now than almost ever before, unfortunately. This I thought was an interesting chart to include, which really shows how the IPO market relative to the S&P 500. And you'll see that there's times where it diverges, but it generally comes back to parity. So growth in the S&P equity markets is very healthy for the M&A market as well. As the stock market's fully recovered after the recession, we would expect the M&A market to kind of gravitate and narrow the distance that you see on the far right of this chart. So we're actually projecting a very healthy M&A market. Our backlog this year is better than it's been in the last 3 years, and we would project a very healthy M&A market. And also, we're seeing more billion-dollar plus transactions as well, which is going to drive deal value. And then lastly, this is the financing market. It's interesting. I think the most interesting one here is the upper left, which is the amount of leveraged loans that have taken place. When I mentioned that the leverage is back, people are lending. It's phenomenal. The only thing that's different is they're lending at lower rates, which is potentially a concern as well. So anyway, that I think is a pretty high-level, quick overview of the M&A market, and love to get into the questions.
First, I have to say you were right, because 2 years ago when we had a similar panel, you predicted that as the IPO market recovered, the M&A market would recover. And since then, we've seen some huge transactions. Last year, for example, you had Yahoo buy Tumblr. That was a $1.1 billion deal. Salesforce bought ExactTarget. That was a $2.5 billion deal. Google bought Waze for $1.1 billion. Of course, the Nest deal I just mentioned. We heard this morning that VMware is buying AirWatch for $1.5 billion. So these are big numbers in terms of the M&A market, and it sounds like you continue to expect that into 2014. I'd like to ask some of our other panelists how they view the M&A market. For example, Peter, you just went public. You're going to raise money on a secondary. Are you planning to buy companies? Is that part of your use of proceeds? And how are you looking at acquisitions and the competitive landscape?
Yeah, I can only speak to our industry, which is the ad tech industry. Our industry has been overfunded. It's very fragmented, and we believe that the industry will rationalize over the next couple of years. We hope to be one of the winners. So indeed, one of the reasons we're raising money and we went public was to have stock to buy companies. We'll be disciplined, so I don't know that we'll close anything, but we want to be in a position to be able to buy companies. And actually, since the IPO, we've gotten probably an inbound a day, because I think people within the industry understand that it's a good time to find a home, and if you don't do it soon, you may be sort of left behind.
So a very direct correlation between IPOs, raising money, and deploying that money into M&A transactions. What's interesting is I think we see a similar phenomenon even on the private company side. I'd like to ask Damon from SurveyMonkey how they are approaching M&A transactions, because they've raised, what kind of capital you guys have raised, and whether or not you view your raising of cash as well to be beneficial in doing M&A transactions, what your plan is on the M&A front. Damon does the M&A work at SurveyMonkey.
I mean, we pay a lot of attention to M&A as a lever for growth, whether it's from a technology, customer, or geographic reach perspective. Right? It's definitely a tool that we try and leverage as much as possible. But similarly, we're trying to be very disciplined, right? So, integrating companies is extremely challenging, and if you're not able to do it, it's kind of worthless to do the transaction. I think by raising or doing our recapitalization, the benefit that we received from the M&A perspective is that we've signaled to other private companies that there's a path to liquidity. Right, it may not be immediate, but there's demand in the marketplace, whether it's from the debt capital markets to help repurchase shares or from new investors, that there is demand for the equity. So it tells them, yes, if we use equity as consideration, you're not going to be sitting on it forever. We have tools that we can use to get employees, investors, and founders, if that's important, liquidity in any transaction. So it helps bring deal flow, not to the extent that a public company would, right? I think that's a very different level, but it is beneficial to us.
And doesn't it also help mark your stock to market, right? So you can really have a credible valuation for your stock as well?
That's right. Obviously, a public company stock price is a measure of one form of consideration. Private company equity is a little bit harder to measure, but if you have a recent transaction, it helps level set in negotiations around what's the value of the equity.
For example, Dropbox, as you probably read, they raised a little bit of money at a decent valuation of $10 billion, and but they're buying companies, right? And Dropbox is still a private company. The sellers are private companies, and they're taking Dropbox stock as consideration. I'm working on a deal right now, and they are using that mark-to-market number in terms of the value of that transaction, and getting comfortable in taking that common stock as well as the path to liquidity that can provide. In either one of your companies, in either Rocket Fuel or SurveyMonkey, were there opportunities prior to the public offering? And Damon, do you anticipate that there will be opportunities for insiders to get liquidity to help sell the M&A transactions?
Well, as we've not closed any deals, but as we've had conversations with companies we're talking about acquiring, that's certainly been on the table. Obviously, founders are interested in taking some money off the table. And typically we buy companies, or if we were to buy a company, we would do so because we think the team is strong. So we don't want to put the teams in a position where they're thinking, I don't have to work again. We want them to be committed to the company financially and otherwise. But it absolutely makes sense to us that if somebody's put their life's work into building a company and they're selling it, that they get some security, and we're certainly supportive of that. Or in theory, we are. We'll see how things go in the real world.
Yeah, that's right. I mean, depending upon how much money they're taking off the table, it's a tool for retention. Right? I mean, it removes some anxiety, allows people to focus on what's the task at hand in terms of building a great business. So we absolutely think about employee liquidity for our existing employees, investor liquidity for existing investors, and then when we're looking to do acquisitions, the same for both their employees and their investors. I mean, I approach it as everyone around the table needs to be comfortable. Right? And so we don't want people to not have to work the day after the transaction closes, because that's hard to retain. But we do want to give people a little bit of comfort for all the hard work that they put in up to that date.
Let's turn to the IPO market discussion. So I think we were talking earlier, Mark, that there's about 70 companies backlogged for IPO right now. You were mentioning that to me. How do you view the IPO market in 2014 compared to 2013? What's changed in terms of getting companies public through the SEC? What sort of issues are you confronting in helping to stage the IPOs and getting them out for 2014?
So as we were talking about, the confidential filing has left a little bit of the visibility down. But as that goes, 14 is looking as good as 13. Oddly enough, the SEC staffed up lawyers, but they didn't staff up reviewers, so we'll see a little bit of slowdown in return. That 30 days, you can usually get the first round, but the second round goes beyond the normal 10 days at times. What we're talking about before is we'll often see companies slow down to get public, and they're spending more time understanding their business, beefing up the whole company along the way, and they're going out much more maturely. Way back to 350 in 2000 or 99, that was just lunacy. So people are understanding it, and I think they are better prepared for the most part once they go out. And they're just taking more time. Like you talked about your pre-roadshow, 2 years of talking to investors. So it's not slam it through real quick. If you go from just the SEC comment side, it's the same thing, revenue recognition, stock comp. Stock comp is a lot better than it used to be because companies are doing quarterly valuations. With that, we've seen some reviewers really dig down into a level that's bizarre on what they want to see in the document. But the easiest thing to do is SEC, respond to them, put it through. I guess, Peter, do you think are you selling off the S1 or are you selling off the roadshow?
Roadshow. I mean, people look at the financials. The S1 is a very thick document. Public investors are remarkably busy. Many of them will have 100 companies in their portfolio. And what they really want to know are financial results. Does this management seem to be credible and know what they're talking about? Those are really the two things. And the bigger funds certainly will have the resources to have an analyst perhaps focus on the industry. So they may well dig into the S1, but in general, it's the roadshow.
The CFO also told me, he goes, well, you're thinking people are reading that S1 to buy my stock. And so it's a little bit, it's a document, it's a requirement, it's a good tool. But if you respond and be good with it, it allows you to get out in the market and kind of don't toy with the SEC because they can stop you. And it's not that big of a document, it's a roadshow that helps with it. And oddly enough, backlog has come up recently. So if the SEC picks segments as, I think the SEC's been around 75 years, they focus on segments for about 80 years. They've picked up backlog recently. So they have their little trends, but it's fairly consistent.
You mentioned earlier that about 90% of companies now are filing confidentially with the SEC. I guess a couple questions. Why would you not file confidentially? What are the other 10% of companies thinking in terms of disclosing their numbers and so forth early on? And then how many companies end up going the M&A route even after they filed with the SEC?
So way back, I think when people were filing, it's half the time they were filing an S1 to get acquired. And it's a nice sales document too. And so in the confidential filing, it's taken that away a little bit. So you'll see someone file confidentially and announce that they're going public. That seems a little at odds with each other. If you file it confidentially, you're just not showing all your numbers to your competitors. So that helps out. I think that's probably the main driver to it. We still hear 30% of companies that start the IPO process do not finish the IPO process. So there's acquisitions along the way. And it just kind of depends what's hot and where things are going.
Peter, I'd like to ask how you guys made the decision around, timing of the IPO versus M&A, ultimately you decided to go public in last quarter of last year, but were you considering M&A as a possible exit for the company?
Yeah, so we were very fortunate in that the company has grown incredibly quickly. According to Deloitte, at least, we're the fastest growing company in the 5 years into 2013. And as a result, our investors had not been in very long, and we weren't under pressure. People were super happy with their investments. There's no pressure like, hey, I've been in this company 10 years, I need to see some liquidity. Our thinking around going public versus selling the company there were a couple things. The first, we're a pre-seasoned team. We're in it for the long run. We think we're in a special position, and we'd be very happy to be continuing to do this 10 years from now. Obviously, we have to think about our fiduciary obligations to shareholders and think about that as well, but our shareholders were aligned with our interests to build something really big. And then secondly, again, I only know about our sector. Our sector is one that's not done particularly well in the public markets. And we thought we had a sense of our value, what we believed we were worth, and we thought it would be very hard to obtain that value in the private markets in a sale transaction, because people would say, well, look what's happened in the public markets, you're not worth what you think you are. So part of going public was to establish the valuation. We actually are not really interested in selling the company, we're much more interested in continuing forward. So the high multiple that we've achieved and the valuation of the stock, we're much more interested in using that to help rationalize the industry, to create capital to invest in our company. But it does also establish a market price for the company if someone's interested.
Congratulations. I mean, that was sort of a courageous decision to establish a new beachhead for the value of the company in a public market where valuations in that sector historically were not that great, and to move the valuations up in the market.
Or just stupid and lucky.
I'd like to ask on John, what do you think are the metrics for companies going public in 2014, and how's that different than 2013 when you guys are evaluating companies to take out?
I don't know that it's too different than from 2013 to 14. The metrics, however, are, it's all about growth in the respect of, getting out. We'd love to see 30+% growth on the top line, organic. And, really it's probably 75 million of revenue and above. You see 75, candidly, a little bit on the low side. You'd probably like to see 100 and above. But, growth, people want to see how this company can be $500+ million market cap, relevant in the public markets in a very quick, reasonable amount of time. So, the days of doing the $40 or $50 million IPO, and, we'll make it up over time. It's just difficult to get institutional investors interested in those. The liquidity's not there. The growth generally is not there. And so, I'd say 75 to 100 million minimum, growing, 25%, but you'd love to see 30% or higher.
Who do you think the big deals will be? I mean, in 2012 it was Facebook, in 2013 it was Twitter and Rocket Fuel. Who do you think is going to make the news in 2014?
I think, you mentioned Dropbox, Box, that sector I think will do very well next year. So.
I have a follow-up question on that. So given those top-line metrics, how does profitability play in?
Yeah, should have mentioned that as well, actually. People like to see cash flow break even or better, or a path to get there within a quarter. So the other is, having companies losing money to generate that top-line growth is not particularly interesting. A good example, company Fleetmatics in the telematics marketplace went public, doing 75 to 100 million of revenue, growing probably 40% at the time of the IPO, break even, really all of that cash flow going back into sales and marketing to drive the top line. Showed a very high return on investment for customer acquisition costs, lifetime value of the customer, good backlog, visibility. All of those kinds of things play nicely into an IPO, but generally want to see a company profitable, or at least a quarter from profitability.
I would just add to that, they're all great comments I agree with, but you do want to take into consideration the SaaS companies. So that with the rare exception of a company like Viva last year, which had actually 3 years of profitability, which is unheard of in the SaaS space, and I think around 130 million trailing 12 in revenues. But some of these SaaS companies can get out with a lot lower revenues because they've got incredible growth. Right? Yeah.
And then you mentioned, Brian, that most of the companies that went public in the technology sector were VC backed, and we've seen a lot of capital going into companies from private equity recently. And I think TPG invested in a number of companies recently as well. I'm curious how you see Wall Street money versus Silicon Valley money going into companies, and what trends there are there. Do you expect more Wall Street-like private equity investors in 2014, or do you think it'll, Kleiner Perkins has a large fund, Foundation Capital has a large fund that they put $150 million in lending clubs. So a number of this Silicon Valley, historic Silicon Valley investors have raised large fund to make later stage investing. What do you see in terms of a trend between the late stage investors as VCs versus late stage investors as private equity in Wall Street in 2014?
It's a great question, and I think that the VC community will always stay as a significant component to the funding for technology companies. Having said that, over the last few years, you've seen a lot more of the actual public investors, like a T. Rowe Price and some of the others like that, getting in earlier. I know Mona DeFrau is here in the audience, and she might even be able to talk a little bit about that. She has some experience there in getting them involved earlier. And in terms of the large private equity funds, they're still out there. You mentioned TPG. And I think there are a lot of funds that kind of are really, I don't want to call them crossover funds like a TCB, but there are funds like Insight, Venture Partners out of New York, probably not traditionally thought of as a venture firm and certainly not based here. And they really go across all series of financings. And I defer to John on this, he knows it better than I do, but the private equity, the traditional PE community saw a pretty significant return last year. There were a lot of liquidity events for them. They've raised a ton of money, and I'm sure more to come. So.
Yeah, I would say absolutely a phenomenon to watch, particularly in the, as you get into the large growth, $50 million and above kind of growth equity. There's really a battle in that layer between the high end of the VC market and the private equity guys coming in and doing minority deals. I think Rocket Fuel actually had some private equity investors, more traditional private equity investors in their last round. And it's really, private equity is comfortable with software now. They're comfortable with the recurring revenue nature of SaaS. They're comfortable with the cash flow profile over time. And you're seeing multiples being bid up in the private marketplace by that battlefield, if you will, between private equity coming down into growth equity and funds like Sequoia, Excel, and others creating larger and larger funds to be in that growth equity land as well. The returns there have been very, very good. And when returns are good, capital follows, and capital is followed into that sector.
Yeah, capital goes earlier and earlier. We saw a number of Series B and C financings in 2013 with later stage investors coming in and bidding up valuations, 100+ million pre-money valuations. Insight invested in a number of companies. So yes, more competition for deals and more players in terms of investors in later stage financings.
In Insight, as an example, they just raised another $2.3 billion fund, so they have to get those dollars to work. And when an investor tells you, well, $10 million round, it's just too small. If you think about the math, a $2.3 billion fund, a $10 million round is too small. They just don't have enough bandwidth or time or focus. So, Insight is, a great firm, been very successful, a lot of cash to deploy, and as a result, writing big checks.
I was just going to ask John quickly if you have an opinion on some of the other entities that are making direct investments, like Wellcome Trust or CalPERS, that it's an added component that typically would go through funds themselves.
Yeah, I think it's the sophistication of investors getting higher. I think it's the companies are more mature and staying private longer and having the kind of revenue profile, growth profile, and profitability profile that make those investors comfortable. And candidly, part of it is people don't like to pay fees. So if we can make the investment as an LP co-invest and not pay the 2 and 20, and we think we have the sophistication and credibility to do that, then we'll do it.
Peter, how did you decide at Rocket Fuel who to take money from in your round prior to IPO?
We were very lucky. We were starting to raise money for our last round and got a preemptive bid. So, we spent 3 months creating the absolutely perfect pitch deck, and then we used it twice. So, and then we did bring in Summit, which is a PE firm, and then Wasatch, which is a crossover public-private fund, which ended up being very helpful to us because they are both quite active in the public markets. And so as we think about going public, talking to banks and so forth, it was nice to have that sort of expertise in-house.
And Damon at SurveyMonkey, what has your financing strategy been, and do you anticipate raising more capital before a public offering?
So the large recapitalization that we did in the end of 2012, beginning of 2013, was about $800 million of capital raised, 50% from the debt markets and 50% from the equity markets or private equity markets. And we weren't necessarily looking to expand the investor base per se, right? We were just looking to determine how we can provide a little bit of liquidity to some investors and the employee base. And fortunately, one of our existing minority investors wanted to lead the round and is now our largest investor. So that's always a fortunate situation where you have someone who's inside and sees the value and wants to take a larger position. That was Tiger Global. So we didn't necessarily go out and look for additional private equity investors. Rather, we looked out in the market and evaluated if there were strategics that were important to us. So, brought in Google from their capital, their growth side, to be an investor. So it was a pretty selective process, but pretty fortunate that we have good relationships and a lot of people that are interested in the company. Going forward, we'll continue to evaluate ways to retain and provide liquidity. I don't think there's any timelines that we have in our head around when we need to do a next capital raise or evaluate one, but the markets they move, right? And so you have to pay attention to them and try to figure out when you can get some of that liquidity.
So it sounds great. 2014 should be at least as good, if not better, than 2013. 70 companies at least on the technology side in backlog for IPO. Lots of competition, both West Coast and East Coast, to put later stage capital into companies, driving up valuations, opportunities for liquidity for existing investors and employees. A lot of activity on the M&A side, both public transactions and private transactions. So, and of course we all know that 2014 will turn out exactly the way we predicted it will be, and that is a certainty. That is a certainty, and John's predictions are always right. So I would like to ask probably the accountant in the room, what are your concerns? What are we worried about? What keeps you, and each of the panelists, what keeps you up at night? And sort of what are the warning signs for the next 12 months?
The article yesterday, is it a bubble? When's the bubble going to close? If you would have said, hey, if the Dow be at 16 a year ago, no possible way. But there seems to be real value and difference than the first bubble. That the companies are a little bigger, they actually are having revenue. There's a few warning signs out there that people went public and had sales and marketing being 50% of their revenue. So those are things to watch and to look for, but it's kind of go get the money when you can. The way they looked at Rocket Fuel, are you in it for the long haul or are you there to go public? I think the world gets tougher once you go public. They turn the treadmill up and you have a lot more rules. So it's not as easy as it sounds, and it's surely not over once you go public.
Peter, what's keeping you up at night? You're going to hope to raise a couple $100 million in the next 24 hours. What are you planning to do?
Put on a suit, go talk to investors. No, one of the reasons we're moving so quickly is not that we have any specific concern about the markets, but the markets are good. Our stock's done well, and just in terms of sort of technical going to market, we're entering earnings season, so if in fact we can be out talking to investors before earnings season is really upon us, they'll have a little bit more bandwidth to pay attention to us. We don't have a crystal ball about the economy, certainly not better than anybody else's. Our business is quite good, that is the digital advertising business, and even if the economy slows, we feel good about that. But if the economy slows, that will tend to hit the stock market, and of course, the thing that will impact the stock market is the thing that none of us know about today, right? And that's the hard thing. So having decided to raise capital, we're doing it as quickly as we can to minimize the risk in this period.
Damon, what's keeping you up at night in terms of helping to continue to grow your business?
Yeah, I mean, we pay a lot of attention to building the business from inside the four walls that we work at every day, and so what keeps us up at night is continuing to grow based on our organic development. So, I mean, it's impossible for us to look out at the market in terms of the equity and capital markets and predict exactly what's going to happen and how the global economy is going to impact what we're doing in terms of here in the U.S. or global expansion. So it's really hard to put a stake in the ground and say this is going to happen in the outside world, so we need to be concerned about it. We spend a lot more time thinking about what we're in control of.
And now I'll ask John, because John's predictions are always right, and these guys get paid. This is what they do for a living, is making accurate predictions. So what are you worried about in 2014?
Yeah, well, I mean, to be honest with you, I think the biggest risk at the moment is geopolitical, but it's the things that you can't foresee. I mean, it's something coming out of left field. It's getting a little too frothy in some of the sectors. I mean, we talked about biotech a little earlier. The last time biotech was an active cycle was 10 years ago, something like that. And now half of the market, I think was your statistic, or something close to that, has been biotech companies. So right now it feels like the economy's getting better. We have to get through interest rates going up over the next 3 years. I think everybody would agree that interest rates have to go up at some point. But it's the unpredictable that is the most worrisome, and it's probably geopolitical. By the way, Europe is doing very well. So we had a record second half of our year. We have 50 bankers in Europe, and Europe has been a very strong, early but strong piece of our business.
It's an interesting observation. Brian, are you expecting more European companies to list on the New York Stock Exchange?
We've definitely seen an uptick, as John said. I completely agree with him. Europe is coming back. I think in terms of what concerns me is even more closer to home, just our political environment, which John highlighted in his slides is the worst it's ever been. And then building on what John said, I met with a healthcare investor recently, and we talked about just this significant uptick that I don't think a lot of people saw coming in biotech and just in broadly life sciences. But it is isolated primarily to biotech. Very few med devices companies are getting out, and others. But as we discussed in this meeting, is that you get the really good quality companies, I think in any industry, that get out first, and then you got to separate the wheat from the chaff, because then there is a rush to the market. But the market's discerning, and there are a lot of smart investors, and those deals are getting pummeled when they're trying to on the road and they're trying to get price, or if they do make it out and they've got some outlandish ratios, the public market is very unforgiving and has a long memory.
I think we'll open the discussion up for Q&A. So if any of you have questions of the panelists, I'll walk around and you can ask your questions.
So I look at a number of deals for entrepreneurs, for kind of startups looking for either trying to get to their first IPO, or excuse me, their first Series A or capital raise, and it just seems like evaluations right now are really, really high. so I'm just curious on your comment. Do you think that's going to continue, or kind of what's your general direction? Because a lot of these, they expect their valuations are just way, I think, too high at this point.
Yeah, I mean, we don't do a lot of early stage funding. Valuations, I think there's a dearth of high quality companies, and as a result, capital is trying to flow and bidding those in. But there's a lot of cash on the sidelines, and it's coming from all angles. So until that changes, and until there's more high quality company formations, they probably do stay high.
So it's a good question for Damon. Buying private companies, is valuation an issue in these acquisitions?
It absolutely is. I mean, I think it's the supply of capital, right, that makes it a challenge today. And we hope that we're looking at all the companies that are very interesting and really doing well. And if you're doing that, they have options, right? And so it's a challenge, right? They don't. If you're looking at a company that has to sell, you probably shouldn't be looking at the company. So valuation is absolutely a concern.
Is there a mismatch in expectations between what the founders of the company want for the company and what you think it's really worth because of their peer set and other factors?
It can be, but there are ways to, if you're a public company or if you're a private company that has a recent market transaction about your worth, there's a relative value conversation that can be had, right? And so that starts to bridge that gap a little bit.
I do think that one of the big changes from the last few years is that people have gotten used to doing private-to-private deals. A couple of years ago, it was almost impossible, or verging on almost impossible, because people now, there's a mechanism for it, valuations are a little more clear if people have been raising money. I do think that that's one of the things that's really increased value in early stage companies as well, in that there is a path to liquidity even if you're pretty early stage, and of course that competes with raising capital and raises valuations.
Hi, I have a quick question. You mentioned Europe and the States. What about China? I was raising some money for a startup last year, and we actually suddenly got a lot of interest from investors from China.
China, well, I guess two things. China, with respect to the IPO market, has had some difficulty. And I think, from an accounting perspective, there's a higher level of scrutiny, not only by the accountants, but even more so by the investors. And we have seen some Chinese companies go public in the last 12 months. Montage would be a successful semiconductor company that's China-based that came public in the US. They were extremely open and transparent from an accounting perspective, hired a US CFO that had done IPOs in the past, so had a lot of credibility, and overcompensated from that perspective. In the private markets, again, at the early stage, less familiar, I think on the M&A side, we're seeing more outbound interest from China. I think that's a result of two things. Number one, Chinese companies trying to offshore cash through investment or through buying companies, and also trying to hedge their bets a bit from a growth perspective and being able to enter foreign markets. So, it's not only hedging their bets from China slowing down and Europe and US increasing from a GDP growth perspective, but also having access to foreign markets easier through an acquisition. So.
A lot of us tech entrepreneurs aren't finance guys at first, and we all start our companies thinking that Google or Microsoft is going to buy us, and that's not the norm. That's just the most bandied about. And then somebody like a PE group calls you, and you have to go to Wikipedia and figure out what that is and who you're talking to. And if the strategics aren't beating down the door, but the PE guys are swarming, like what does that mean for a tech entrepreneur? And are they the people you sell to only after you've exhausted every possible strategic?
Well, I think, and it's hard because tech entrepreneurs are very focused and working 100 hours a week in their companies, but you just have to be educated, right? And there are great PE firms out there. There are advantages to doing business with PE firms relative to strategics. But until you get out and talk to people, you really don't know. I mean, part of it's understanding the people themselves, like, do I want to work with these people? But also, you can't talk to one PE firm or one strategic or one venture capital firm to understand what your options really are and to be able to start to formulate smart questions, right? And make your own decisions. So my advice to people, and it's very hard to do, is get educated, and it's hard to do because it takes time. You got to be smart about what you're asking, network, have you worked with these people before? And I think a lot of people focus on building advisory boards or early investors who have experience in these areas. So, I mean, as I said earlier, we brought in a PE firm and a crossover fund in our last round because we wanted to leverage their expertise in accessing the public markets. As an earlier stage company, you can do exactly the same thing. Get somebody within your circle who's done this before and can give you advice. But the only way to make the right decision is to spend time on it, and that's a big investment.
And I'd say that every investor is different. The level of control they want over the company, level of the number of handcuffs they may ask for with the founders, a level of control over the ultimate M&A transaction. It really differs. I mean, there's some venture funds that will require more control. There's some private equity funds as investors that will require more control. But it really depends on precisely who you're talking to.
The other thing I would say is a lot of private equity funds, particularly in the growth private equity world, have teams of junior people that make outbound phone calls constantly looking for opportunities. And so if you're getting the call of, gee, my name is Jimmy Jones and I'm from XYZ firm and we're really focused on your sector and your name came up and we'd love to talk to you and learn more about your business. There's legions of people doing that now looking for proprietary deal flow. I think it's extremely valuable to get to know the natural strategic acquirers in your space, whatever that is. We get phone calls from successful entrepreneurs that say, look, Google should really own my company. We'd love to sell to Google. And our first question is, has Google ever approached you? Have you talked to Google? And you'd be surprised how often the answer is, well, no, but they really should own our company. We can fix one of their problems. So, having a dialogue with a natural strategic over time, I think is helpful. You might have an opinion coming from SurveyMonkey on that too.
Yeah, I think it's critical. I mean, I don't envy all of the relationships that a tech entrepreneur has to have. I think you guys have a huge task in managing your existing investors, potential new investors, strategic acquirers. There's a lot of people to build relationships with. But as a buyer, if the first time we're talking to a target is we get the call because they're running a process, that just doesn't set things off on a good foot. We don't know enough. We're not going to be irrational. And so we want to take our time and get to know you, the people, the business. And so even if your plan is not to be in a position to sell or exit for 6 to 8 years, knowing the acquirers, after you're 2-3 years in, I think is important.
I'm curious if the landscape for IPOs has changed. I mean, famously, Facebook was kind of forced into going public through the number of shareholders. Has that been changing as more private companies are acquiring with equity as they're taking these larger rounds? Have some of the pressures on private companies to sort of be forced into the IPO through technical requirements of like number of shareholders? Has that been changing recently?
It did under the Jobs Act, so that the 500 share item got removed or elevated to a higher.
It's like 2,000.
Yeah, 2,000, 2,500. So that item was removed, and now it's the items that we talked about up here that the private can make an acquisition or pay some money, give some liquidity to the founders. So it's not a technical item anymore. That was removed.
Question I have for you.
I was just going to say it's interesting that we say Facebook was forced to go public at $60 billion valuation, right? So I consider that a complete and utter outlier from most cases. So,
and do you really want to have 500 shareholders? I mean, that's one thing. When I work with companies, I counsel them around limiting their number of shareholders. And it comes up in a real dramatic way if you're going to sell the company. Because most buyers are going to require every single shareholder to sign the acquisition agreement. And recently I sold a company to Apple. They required every shareholder to sign a confidentiality agreement before we could even disclose who the buyer was and what the terms were that we could present for them to consider. So we spent a lot of time rounding up everyone. I even drove to Los Gatos to meet a shareholder at Starbucks to get them to sign the non-disclosure agreement.
All the way to Los Gatos?
All the way, somewhere down there. Usually I'm going that direction. It was pleasant, it was nice.
That's great. Question for Peter. You mentioned that one of the reasons, I'm sure there are others, rocket fuel went public is because the industry, the ad tech, has been misunderstood, undervalued, whatever. Can you talk about what were specific issues in ad tech which undervalued, misunderstood, and how this has changed overall in the industry?
Well, I would guess that ad tech has been one of the most over-invested in industries. So there's a ton of money that's gone into the industry. And one of the things that's unusual about ad tech is a lot of the money flows through advertising agencies. And the advertising agencies are paid to try new things, and they actually don't get paid unless they spend their clients' money. You know, the agency X has got to spend BMW's money or they don't get paid. So for entrepreneurs, it's pretty easy to raise capital, and then it's pretty easy to get revenues, which is very different than, let's say, an enterprise software company. In an enterprise software company, you got to convince a guy like me to give you extra budget. In the advertising business, there are people who need to spend money. So as a result of these things, and because it's a very, very large market, there's been a significant amount of growth of smaller companies in the industry. And then, of course, you know, Facebook has come into being very powerfully in the last few years. Mobile is growing incredibly quickly. So there's just a lot of change, which also brings many companies, has brought many companies into the industry. So that's one piece of it. So you have a very complicated ecosystem, a lot of companies competing. And the issue specifically in the public markets is that a number of companies, not naming names, have gone public with technology claims and unfortunately not performed well. So, you know, fool me once, shame on me, etc. So the issue has been complexity, companies going public with technology claims and then not being able to back them up with financial performance. And I think that just by virtue of where our industry is, that will change over the next couple of years. The winners are emerging, and it's one of the reasons the investors are willing to spend time with us, even though they've been snake bit before, because they know there are going to be some big companies that come out of this. So I mean, what I tell investors is like Darwin's footsteps get heavier every day in our industry, and if you feel confident that you can pick some of the winners, then there's an interesting opportunity. And I have no idea if I've answered your question.
We have time for a couple more questions.
This question is for Peter and Mark. What are the biggest changes you've seen in the IPO process compared to, say, 5 to 8 years ago?
It's first the confidential nature of it. You seem to get out quicker. You can get out there and that you plan for a little farther ahead of time. People are adding the right resources to it, as we've done other IPO readiness panels. The most interesting chart I have that you can give all the rules, everything it needs to be, is the org chart and the finance org team and the legal team to make sure you have the right bodies in place. Because again, once you go public, the real work begins.
Yeah, I think that's exactly right. I mean, the last IPO that I did was during the bubble, and I've actually looked back at like the roadshow deck that we used, thought about the finance organization and legal. We did not have in-house counsel actually at that time. And you know, a board that's awake would not allow you to do that today. And any intelligent corporate executive would not want to go public in that context. So the demands on the company are much higher. And because of Sarbanes-Oxley and the other regulations, the impact of missing are much more significant than they were. It creates a real dilemma for companies considering going public, because you can't have a couple of people in the accounting organization and think, well, we'll go public. You have to start the audits early. You have to be ready to close timely and accurately. That takes real effort. You need to invest in a team. We were very fortunate to have a general counsel who'd been with a public company. So we had a real investment in our infrastructure. That's what I spent a lot of the last 2 years doing, is building that team. Having said that, so that's the harder part. That's probably good, right? I think even if there's a bubble in the sense that values are high, and maybe values will come down, there's not a bubble, in my opinion, in the sense that 80% of the companies that are going public are going to be gone in 3 years, which is what happened during the last spike in IPOs. So maybe just values are a little high, but these are real companies going public. The Jobs Act has made it easier to go public, but I actually don't really think, and this is my experience, other than the confidential filing, that it's really made much difference. There are certain things, like you have a longer period to become SOX compliant and so forth. We will not take advantage of that. We just think that that's not the right way to be a public company. So it was great to be able to file confidentially in case the markets didn't stay strong, and our numbers wouldn't be floating around. But in general, I think people are not. I think if you want to take advantage of the other things that are in the Jobs Act, then I would ask people to reconsider that. You really need to take this seriously and get it done.
Great. Last question.
Oh, thank you. By the way, thanks for just excellent panel, very informative. So my question is regarding the 2014 outlook. I mean, with looking at all these, backlog of filings as well as the M&A going on, you feel that the tech sector and healthcare are going to be at the same pace, or something else is going to happen this year?
No, there's no reason, it's sort of the double negative, but there's no reason to believe that it won't be the same. Again, our backlog on an M&A perspective is higher than it was the last 2 years. Part of that is tax driven. So in 2012, if we remember, there was a change in the tax code. So anybody that was thinking of selling a business in early 13 tried to accelerate it in 12. So in January and February, it was almost like crickets, and then the business started back up. We don't have that phenomenon this year. That's a reason for the backlog. I think on the IPO markets, it's hard to predict the stock market. We have a specialist that does that. He's right 70% of the time, which I think is pretty good. And his prediction for this year is a pullback at the end of Q1, early Q2, 10 to 20%, and then really, in his opinion, the next seminal bull market will begin. The last prediction I would say that I think is not obvious to people in Silicon Valley, and what that is particularly in software and SaaS companies, I think the buyer universe for those companies continues to expand every year, which is good news. It used to be if you were developing a software, or you're starting a software company, it was Microsoft or Oracle, SAP, IBM were your acquirers. As we have more SaaS companies focused on verticals, there's more corporate America focused on those verticals that are looking to move from commodity hardware to differentiated products and software. And so we've seen, in the last year, we've sold 2 companies in the fleet management space to Danaher for $600 million combined. I don't think anybody in Silicon Valley knows who Danaher is. It's a $35 billion industrial conglomerate. They bought 2 SaaS companies in one sector because they were very focused on having those tools for their clients. Roper, they've bought $2 billion worth of software companies in the last 18 months. Again, a company that probably very few people in Silicon Valley have ever heard of, yet they're a large industrial conglomerate that is looking to differentiate themselves through software, because candidly, differentiation through hardware and selling it one at a time is not near as interesting as high margin software, recurring revenue, and corporate America is figuring that out. So that's something that I think is a phenomenon that's not noticed in Silicon Valley, but I think is going to increase every year. And it's good news, more buyers.
Great. I'd like to thank each of the panelists for coming today and giving us some very valuable insights into what's happening this year. Thank you.